All right. Today is, Wednesday, the 31st of July. This is a recap for the stock market activities today. And folks, I got a good one for you tonight. Happy last day of the month and happy FOMC day. Now, with regret and sorrow, I must admit that I did watch the conference by Zombie Powell. Unfortunately, though, he put me to sleep. So I woke up a little late. I couldn't catch up the chat on Discord. I forgot to put the live stream highlights. I went to sleep, literally. That's how interesting the FOMC was. And the take from the whole circus that we got today is Mr. Powell chickened out. He's been teasing and talking about rate cuts and how he defeated inflation, tough guy. Okay, do it. Cut the rates right now. But now he says, oh, we could. This is talking about September. We could lower interest rates. Wait a minute here. I thought that September was in the bag. Now you're talking about it as could? What's going on here? And of course, the propaganda media says that Powell said September rate cut on the table if, here comes the could and the if, inflation data continues to cool. No. That's bullshit. Inflation data has cooled enough for you to cut rates if you wanted to. And I corrected the headline to Powell says September rate cut on the table if the shit hits the fan. That's what it's really all about. He wants to see more weakening in the economy. He wants to see the market going down, you dummies. He's afraid he's going to cut right now and inflation will come back. He needs to see more assurances, not from inflation, but from the weakness in the economy and the market dynamics. That's what he did not say to everybody today. But of course, you have to read between the lines. Otherwise, you would have cut rates today. Anyhow, we will talk about the Fed and the bond market dynamics in a minute. But I know a lot of you pointed this out because you saw the VIX being elevated today. By the way, oil was surging today for multiple reasons. Multiple tailwinds. We got a trifecta of bullish catalysts for oil today alone. And you think Powell didn't notice that before he got to that stage? Of course he did. And he knows that the moment he cuts rates, he's going to add another catalyst for oil to go higher. But I'm talking about one of them here, which is the geopolitics. And boy, this Middle East war is about to get ugly. Yesterday, we got the report that Israel assassinated a Hezbollah leader in Lebanon, not in the borders this time around as we've been seeing so far, but within the heart of Beirut, Lebanon, the capital. So this was an attack that's going to require retaliation by Hezbollah. A guarantee that's going to flare up. The northern front, as we call it in covering the war, will flare up now even more. And we know that involves Iran right off the gate, and the involvement of Iran is what really scares the market and the global economy and even central banks, because we know at the moment we have an involvement of Iran versus Israel face to face, now we got oil at above 120, perhaps 200 at some point. Well, guess what happened shortly after the assassination of the Hezbollah leader? We got another assassination, this time around for a Hamas leader. This is the political leader, not the military leader, the negotiator actually. But he got assassinated in Tehran, Iran. Huge escalation. And now, of course, this is a major embarrassment for Iran, because if Israel can hit a political figure in the heart of the capital of Iran, they're sending a message. It's a clear message to Iran. Now, Iran has to respond because it is a huge embarrassment. And this is not going to be let's fly a bunch of rockets and blow them up in the skies and make expensive fireworks. This is going to require a legitimate retaliation. And immediately we got the headline that the Ayatollah is now ordering direct, and this is a quote, end quote, direct attack on Israel. So here we go. And let's be honest here, folks. It's pretty much in the bag that the war is going to escalate. It's pretty much in the bag at some point. We're getting maybe 80% in the bag. So we got 20 more, and then it's in the back for sure that we will see the involvement of the United States in a greater war in the Middle East. Of course, from an investor standpoint, from a financial market standpoint, what do you do here? You go long oil and you go long the defense contractors. Look at this recent pop in Lockheed Martin. In the beginning, I thought maybe it's a rotation of value into dividend-paying stocks, and there is some truth to that. But we've seen some of these dividend-paying stocks pulling back recently. Lockheed and the defense contractors keep going higher and higher and higher. Maybe we'll see it sell the news right now with a pullback because it got excessive. But the point is, A, you got to be long the defense contractors. I've been saying this for years now. But B, what is it about this pop that we've been seeing recently in the defense contractors? I don't think it's just about value or defense or rotation of dividend-paying stocks. I think somebody knows that we're getting into war here really, really soon. Let's go back to Lockheed in the aftermath of 9/11. Big pop higher and a rally exceeding 85%. in anticipation of the war. Well, this is going to be a bigger war. And I know what you're going to say, but Maverick, the United States is never going to do it. It's not in the interest of Kamala Harris or Donald Trump. Nobody's going to do it right now. Understand one thing here. We have failed to get this thing under control from the get-go, which we should have done. And I've been saying in the program repeatedly, we should have established American dominance, that there are red lines, and if you cross them, we're not with you anymore. You're on your own. That's the only way you can establish dominance. But of course, we showed a lot of weakness, and you got the Israeli Prime Minister, Netanyahu, and I said this from the get-go. This guy is going to extend the war and expand it as far as he can, because the moment the war ends, the music stops for him. He'll be in jail. And the Israelis are going to be the ones who are going to do it. And this is why this whole speech in Congress that he did a few days ago when he came out and said, hey, do you remember who the boss is? And all of your beloved politicians stood up and clapped like a bunch of seaward seals, including Reverend Elon Musk, by the way. A lot of you think that Elon Musk is anti the establishment and all of that. No. Elon Musk is a CIA asset. Elon Musk with his X, the whole thing about X is to expose your data and sell it to the government and let the intelligence to see all of the conversation and the stuff you guys post under the disguise of freedom of speech. But anyways, the point being here is the Israeli Prime Minister, when he did the speech, he talked about the head of the snake, that you can't really fight these proxies and call it a day. You gotta attack the head of the snake, and in his opinion, that's gonna be Iran. Okay, sure, go ahead and then start a war with Iran. He's not gonna do it on his own. The point behind the speech in Congress is, I'm going to do it, and you guys have no other choice but to go along with the ride, baby. Because I know some of the people in the State Department and the intelligence apparatus of Uranus and the Pentagon are mad about what Israel is doing and all of that. They want to establish U.S. dominance, but I'm here, me, Netanyahu, to show all of you that I got control over Congress and the Senate. At the end of the day, voting for war comes to the Congress and the Senate, not individuals in the State Department or in the Pentagon, or in the intelligence apparatus. So unfortunately, I think we're heading that way. And we'll see what Iran does. It's probably going to be a big response. Don't forget, of course, about the Houthis in Yemen. They want a response too. Hezbollah now wants a response. So it could be a big response against Israel. And then Israel will have to respond. And it could be via face-to-face fighting with Iran. At that point, it requires the involvement of the United States. And here we go. Now we have a big war in the Middle East again. Unfortunately, I think we're heading that way. And you look at the action in the WTI today. For example, crude oil up 5% in a single day. And it wasn't just that tailwind of the war that pushed crude oil higher, but it is imperative to understand, because as these geopolitical risks keep brewing, you will see gold moving higher, you will see crude oil moving higher. And that's inflationary, ladies and gentlemen. That goes against the mission of Powell of reducing rates or rate cuts by September. If we have oil at 100 this summer because we got a war, forget about rate cuts in September. And I think Powell is aware of that. He knows the geopolitical risk. So a lot of you said in the questions today, where do you think we are in the map that you gave us over the weekend? And I think right now, Fed held rates because they need to see more. That's the excuse. Doesn't matter which one it is. But I think that the dollar and bond yields heading higher. And we're in the scenario of tech earnings now coming out good because of Meta. We'll talk about that in a minute. I think it's a rotation to AI and big cap and commodities now. The wild card in all of this, I know what you're going to say, but yields are down, Maverick. You wait, they're going to go higher again. The wild card is the dollar. That we could see the dollar down, yields finding a footing. And that's even a worse scenario than the one that you see right now. Why would we see the dollar down? It ties in now with the other catalyst that pushed oil higher. It's the intervention by the Bank of Japan, who finally capitulated and decided to raise interest rates higher. And now they're outlining a roadmap for a trimming bond buying program. Well, what does that mean? It means that there's a huge whale buyer of U.S. bonds who's been suppressing yields, at least in the long end of the yield curve. That buyer is no longer here. They're going to trim the buying. And it's imperative for you to understand what you're looking at right now in white is the 2-year yield versus the 10-year yield. If we're trending down, it means that the 10 is outperforming the 2. And that's not good for equities. You see, the NASDAQ goes down every time we have this. And this is why Janet Yellen been manipulating and suppressing the yields at the longer end of the yield curve. But every time we see the 2 outperforming the 10-year, as we've seen recently, it kind of precedes a rebound in the NASDAQ or the stock market. So it sort of serves as a leading indicator. And if you begin to see that the 2 versus the 10 going down, meaning the white chart going down, then what we're seeing in the NASDAQ right now is a bull trap. And we're going to go down again. Why do I think that's going to be the case? because the 10 will begin to outperform the 2. We have exhausted all of the talk about the Fed is going to cut rates on the 2-year yields end. Now we got to factor in what happens when you take Japan out of the buying equation. I know, by the way, perhaps the revival of inflation because of geopolitical risks. I think you see the longer end of the yield curve coming back and outperforming, and that's not good for equities. But rest assured, you got Janet Yellen, here she is again, announcing that the Treasury increased liquidity buyback total to $30 billion from $15 billion, a double, playing with the country's wealth and taxpayer money to manipulate the market higher. She knows that yields at the 10 and the 30 will spike significantly higher because Japan is out of the equation right now. And oh, by the way, we got geopolitical tensions that will push oil higher, which means that folks will begin to price in higher yields at the 10 to the 30. So she comes out with the solution right now by doubling the liquidity buyback program. This woman should be in jail if we had any dignity in this country. They call it corruption, misuse of public funds. But of course, we don't have the balls to do that. The other problem, by the way, with what's going on with yields coming down in the 30 years. So you're going to eat it either way. If the 30-year yield, for example, goes higher because Japan is not here, and the liquidity program is dismissed, that's not good for equities. If the 30-year goes down and mortgage rates drop down, look at what we got today in macro. The headline reads, pending home sales post surprise jump in June due to the rising number of home listings. And it was a huge beat. We were expecting a negative number. We got a positive number by more than 4 handle. The increase in supply in the housing market. Don't forget about the pipeline coming from Lennar and Pulte and Toll and all of these companies. And the supply coming from folks abandoning their Airbnbs. Business is not good anymore. They got to list the homes. And homeowners now looking at mortgage rates coming down, maybe they're trying to time the market so they're listing their homes right away. What do you think that's going to do to the housing bubble? It's going to burst. Home prices will go down significantly. Good for inflation, but recessionary, because a lot of the spending in the economy and the overconfidence by the consumer is, you might have read the headlines today, that 1 in 15 Americans are actually millionaires. Does it feel that way? Of course not, but because we're sitting on asset values that are worth more than $1 million because of the inflation in home prices and equities prices. You take home prices down, you reduce the confidence of the consumer to keep propping up the economy. Not a good situation, no matter how you look at it, folks. The other question that we got today. Hey, Maverick, the Japanese yen is going higher, but the Nikkei is going higher too. Nikkei is coming down. If the yen continues to go higher, Nikkei is coming down. I mean, you see the correlation right here. The chart is of the Japanese yen index, and in white, this is the Nikkei, and you can see every time we have devaluation of the yen, Nikkei goes higher. Every time we have a rebound in the yen, move higher, we see the Nikkei coming down. And it went down significantly as we've seen a recent rally in the Japanese yen. And if it continues, we will see again the Nikkei coming down. But there's something in psychology called relief bounces, relief rallies, better than expected, worse than expected, and we see some divergences. But it's going to be sorted out. Either the Nikkei goes higher, Japanese yen goes down, or Japanese yen continues to go higher as we anticipate. Maybe not in the short run. Maybe it's a little overbought right now. It pulls back a little bit. But in next week and beyond, it might continue to go higher. Matter of fact, I would bet it would continue to go higher. With that, the Nikkei comes down. Now, let's talk about our market here. I mean, we talked about it kind of with the bond market and all of that, but let's talk about the equities market. Big rebound in the indices level today. The question now becomes, is it it? Are we done with the correction? Higher we go right now? Let's take it one step at a time. Yesterday, we talked about the IV rank in NVIDIA reaching 100. And NVIDIA is the market leader by far, even bigger than Apple. And we talked about the 100 days moving averages support. And I said, folks, if you've been short, close your shorts. But on the other hand, I also said that maybe it's not the time yet to go on the long side to buy the calls. Well, I was mistaken because today the name is up 10 to 11% in a single day. So the shift happened right away in the pre-market session. You could barely wrap your head around it or chase it if you'd like. Matter of fact, NVIDIA added $329 billion in value today alone. The most in market history. It's a joke at this point. With that being said, I think we'll continue for a few days, maybe a couple of days, then come down again. One step at a time, folks, because the chips got a catalyst, not just from the oversold NVIDIA situation, but it got a catalyst, a fundamental catalyst overnight from the AMD report, even though AMD kind of faded during the session. But we got the news from Reuters this time around. It could be a rumor, by the way, not confirmed right now. Matter of fact, there's a report by Bloomberg that said this is not true. But for now, the talk is there's a new bill with restrictions of chip components to China. But the rumor is that we have exemptions to the allies, the Dutch company ASML, some of the Korean companies, some of the Japanese companies, because they're getting mad. Say, look, we're kissing the American ass for a long time. But we got to do business here. You guys have all of these companies. You make a lot of money. We got to make money too and do business with China. So maybe we're giving them the exemption that, sure, you can do it. Go ahead and sell stuff to China. And we see ASML going higher. Based on that, we've seen a lot of chips also catching the tailwind and moving higher. You got the Nancy Pelosi news that she bought shares in NVIDIA. That adds up too. But here's the bill. The details are not out yet. We're going to get that really soon. The U.S. mulls new curbs on China's access to AI memory chips. So this is from Bloomberg now. Negating, by the way, the exemption reported by Reuters. But right now, the detail that we got is it's going to target memory chips, specifically from Micron. Now, Micron is already banned from selling those memory chips anyways. But it's going to target Korean companies too that are selling the memory chips. Because if China get their hand on these memory chips, they can develop their AI chips on their own and rival NVIDIA. So it goes contrary to the news that we got that we have exemptions if we're now targeting Korean companies and banning them from selling the memory chips. Anyways, we'll get the details really soon. But we go back to the question. Done with the correction, higher we go again, per usual, higher highs, and we continue the same thing over again. One step at a time, folks. It smells like a trap. It might last a couple of days, but be careful. The action in the VIX and a lot of other indicators say that we're not out of the woods yet. We will see it's a trap, at least for now. That's my assessment. Evidence number one. You got your boy Jim Cramer saying, so much bullish reaction today. So say a prayer to the rebound. It's probably not going to last. And of course, the other indicator, I talked about that Q&A video that I was going to release, but did not release, but I want to release, yet I don't want to offend a lot of you. But it serves as a great sentiment indicator because you guys were bitching and whining right at the top of the market before the correction. Matter of fact, there was one viewer who said, Maverick, I give up, I capitulate, I'm buying right now. And that poor motherfucker bought right at the top. And we can do the bearish version, by the way, which is yesterday and a couple of days ago, where it was kind of hyper bearish, the commentary and the questions and all of that. And right away, you get a rebound. So maybe we should do those sentiment indicators based on the comment section. But here's the other problem, because we got earnings after the bell, and some of them are not good, coming from chips. So you got Qualcomm. It was up initially, then it went down 1.5%. But again, the name was up over 8% during the session, so whatever good news was already priced in. Then you got ARM, and ARM lost an arm. It's down about 12-13% last time I checked. This is not going to be good, of course, because we see overpricing of the chip components relative to earnings not being justified. The pricing is not being justified by the reports. We're not seeing horrific reports, by the way. We're not seeing negative numbers or demand stalling or dropping down in a big way, but we're seeing that a case where the valuation of the stock exceeded all expectations, set the bar way too high that these reports cannot really deliver based on these expectations. But we got perhaps a more important company. When you talk about ARM and Qualcomm, you're talking about a few $1 billion. But when we talk about Meta, we're talking about the $1 trillion club. So it matters more. And last time I checked, Meta is up about 7% after the bell. That's going to paint the tape for tomorrow. That's going to continue that rotation, in my assessment, out of the smaller caps and the recent names that went higher, back into the big caps, back into the chip components, but it's going to be a trap because they'll go down later again. And it could be as soon as tomorrow when Apple and Amazon come out. But one step at a time here. We did not play a lotto on Meta because the options were so expensive. And even if we bought the calls, by the way, they were pricing in a 9% plus move. So the 6 to 7%, you would have lost money either way. Instead, we've done some lotto tickets on the TSLA for the FOMC. We got the calls and the puts. And we got a pop, by the way, in the IWM initially, so you could have closed one of these legs and then managed the other. But if you didn't, tomorrow's session will be interesting to manage the straight. We got the SQs too. We got the puts and the calls. Cheaper lotto ticket. I think it will play out tomorrow, but you might do, you get an initial pop in the morning where you have to close the puts, and then the calls begin to work out in the inverse index, the SQs, as we see a pop, then followed by a pullback. Now, let's talk about Meta's earnings and details. Here's what you need to know. Going back to 22, the stock was hammered, bruised, down trillions of dollars, crash in Meta. And it was justified because a lot of people say that the stock market doesn't care about the fundamentals. Actually, it does. And it precedes the fundamentals. So the drop that we got in 22 was actually reflecting the negative net income growth that we got from Meta during 22. But then 23, we began to find a footing for Meta, and the stock recovered. The reason is, we were anticipating that the margin problem is over for Meta. And indeed it was. You can see that they managed costs pretty good and revenue came back. So Q2 23 Revenue goes up, costs stay the same. Then comes the best 2 quarters, really Q3, Q4, where we see the revenue moving significantly higher, but costs go down negative. All of the layoffs now showing up. The stock already priced that in by rallying beforehand. Then comes Q1 2024. Revenue keeps going higher, but costs come back up. So the stock stalls. Now, are we seeing peak revenue? Are we seeing peak net income because the costs coming up? We get the report for this quarter, revenue down and costs are up. So on face value, not a good outlook for Meta. That maybe we've peaked in the revenue growth and we have bottomed in the reduction of cost. Keep that in mind because you can see Meta going higher tomorrow, then reversing right away. But the important thing is the bottom line. So you look at the net income growth, as we said in Q1 23, we're still impacted by 22. So you've seen a minus 24% growth rate in net income. It was reflected in the stock market crash in Meta. But then things improved and the stock began to recover and move higher in anticipation of these really decent numbers that you see in the net income. Up 16% in Q2 23, up 164% in Q3 2023, up 200% plus in Q4 2023. Now, what is the take here? Sure, the company reduced cost, and it matters. And Zuckerberg matured a little bit from his metaverse fantasy and the spending on steroids. But there was also something called the law of numbers. And since the numbers in 22 were way too low, it was easy to beat and show 164%, 200% increase in the net income. But as we begin to go into 24 and pin ourselves against Q2 and Q3 and Q4 from 23, where the numbers are big, there is the law of large numbers, meaning that sure, the improvement in the net income after Q4 23 went down from 200 to 117%, still decent, still pretty good, but you're comparing yourself with Q1 2023, which was minus 24%. The recent report that we just got, net income is up 73% year on year. Pretty good, but it's being pinned against the growth of 16% the year before. In the next quarter, we'll be pinned against this massive increase in net income of 164% year on year. So in all likelihood, the growth in net income has peaked in Meta. We're going to begin to normalize, where the next report, it might be a net income growth of 40 to 50%. Then we go down to 30, 25, then the teens, and settle back to the neutral territory in Meta. And with that, the stock price will react the same way. Am I saying we've seen the top in Meta? Sure. You look at the operating margin, again, it peaked in Q3, Q4 23, 40%, 40% plus, pretty good. And right now, maintaining a really decent operating margin, but we've peaked. The thing is, go back to the net income. What was the growth year on year? 73%. The stock price since that period is up about 59%. So there's a case of underpricing a little bit here. But remember, the stock looks forward. So what's going to happen is we fix some of the underpricing, maybe fix the gap above, close it at around the 500-ish level, and then come down again because the stock is going to look forward, and the law of large numbers would say that assuming the macroeconomic and the spending stays the same in the revenue side, the net income based on the law of large numbers will be perhaps in the 40s, 50s. So we got to drop the stock down to price that in. And if the macroeconomic situation deteriorates, we see an impact, a negative one that is, on the revenue side, now we have to price in more and more declines. So this is what you have to understand about the stock market action vis-a-vis the fundamentals, aka the reports. They all tie in together. And if you don't understand it, you're just gambling on the stock market. You're just lucky that we have a passive investment bubble. But you're not really a good stock picker because you're not tying in the fundamentals with the stock price movement. I'm trying to teach you that right now, right here. In any case, let's add more color to the conversation here, folks, because we have a lot to talk about. Let's segue to the market information. We begin with the closing of the indices today, and here we go. The diamonds in the green by 99.46 points, or a gain of 0.24%. The Nasdaq, the leader of the day today, 459.98 points to the upside, or a gain of 2.64%. That's the rotation back to AI and the big cap mania, but mostly AI. You got the S&P 500, the spider, up by 85.86 points, or a gain of 1.58%. The IWM, though, disappointing reaction. Everybody was betting that the IWM will be the one that leads, but the IWM actually closed below the highs, way below the highs, scoring a gain, though, of about 1.29 points, or a gain of 0.58%. Look at these charts, by the way. If you're talking about rotation, look at the Dow Jones, which is the value rotation. Look at the Russell, which is the risk-on rotation. Look at the last hour or so worth of action. Are we seeing rotation into these names? No. Now look at the action in the Nasdaq and the S&P. Those managed to hold the post-FOMC gains a lot better. So this is your hint right here that's probably going to be dollar goes up, even though maybe masked by the Japanese yen, and yields are going to rebound. And that's going to be good for the rotation into the big caps because we got the catalyst from the chips that we're going to remove the restrictions, although we're going to sour really soon on that sentiment. And we also have a good report from Meta, which should accelerate that rotation back into AI and big caps, but we take it one step at a time because I think at the end of the day, it's going to be a trap. We'll look at the performances. What do we see here? Number one sector is technology. No surprise. Rotation back into AI. But we see the dollar going down because of the Japanese yen. So metals are number two. We got cyclicals at number three. We got utilities, defensive, yield sensitive. Yields went down today, so we see utilities number four. The laggard, though, this is really interesting. So consumer defensive down because of Procter & Gamble and some names that reported today. Got it. But real estate is the laggard of the day. Now, between utilities and real estate, which one is the risk on versus risk off? Risk off is utilities. Risk on is real estate. There is a message here from the action that we got today. We look at the breadth all in all. NYSE 71% advancing versus 28% declining. The NASDAQ 60% advancing versus 37% declining. Good breadth across the board, whether you look at the advancing declining ratios or the 52-week highs, everything looks pretty good today. You look at the heat map, it is reflected right here. You see a rotation out of the rotation. Which names been catching a bid recently? The small caps, the riskier names, the yield-sensitive names. I mean, think about names in financials, for example. The regional banks, the actual banks, the real estate names. All of these are risk-on type of rotations. All of them are lagging today. Then you have the risk-off rotation in value and dividend-paying stocks. Look no further than the action that we got in healthcare. You got J&J, Pfizer, Bristol-Myers, the names that we've been talking about recently, actually going down today. What's moving higher? Eli Lilly, NVO. Rotation back to growth. You see it in industrials, not in terms of pulling back on the risk-off rotation, value/dividend rotation, but you see it in the rebound in the growthier names that got impacted by the rotation, like Eaton, ETN. That's the biggest gainer in industrials today. And of course, all of that rotation is flowing back into the chips. So we see the chips as we talked in last night's video, that we could see the dynamic of chips going up big, but the big caps lagging. We have the chips going up big, the big caps mostly in the green, but lagging the chip gains. And you got one big name in Microsoft down about 1% for the day. So for now, I think we have a little more juice to squeeze in the chip rebound. And then we have tomorrow, probably going to be the big caps outperforming the chips because of Meta. But after that, I think we're going to sour because we will see that energy prices probably going higher. We will probably see yields going back up. And the problem with that is if you sprinkle on top of that a bad report from Apple or Amazon, then we're going to pull back again and we're probably going to rotate back into value, not necessarily the small caps or the risk on. So keep an eye here. The pullback in value, in my opinion, and by value, by the way, I don't mean the shitty names that you guys are giving me. Hey, this is a value cheap stock. No, it's not cheap. It's garbage. It doesn't even pay dividend. We're talking about high quality, profitable companies with dividend, but they've been lagging. I'm not talking about names that crash 20, 30%, and we call that value. Anyhow, we look at the heat map for the ETF. Steel T up, meaning bond yields down. And of course, the dollar is down big. So let's begin with the yield rotation. What do we see in the yield rotation? Let's look at risk on. Risk on meaning KRE. IWM, IYR Real Estate, XHB Home Builders, ITB Construction, XBI Biotech. Most of them are down for the day. So that tells you right away that the rotation was actually favoring risk off, meaning the XLU gaining some ground. You got the VTV, value stocks, mid-cap stocks outperforming today. So that's the impact of yields in the market today. Then we have the impact of the dollar. So the dollar went down right off the gate. Commodities do pretty good. Look at the gains in USO, for example. Yesterday we pointed out, even in the morning brief, we pointed out that, look, USO, you got to buy that because it is oversold. We would see a rebound in USO, and we got a big one today. You see it in gold, silver, GLD, SLV, GDX. You see it in oil stocks, XLE, XOP. You see it in international markets, the Chinese equities going higher. You see it in the negative impact on crypto ETFs. Those are down for the day. So that's the dynamic. And of course, on top of that, the rotation, which is moving the chip component XOXX, SMH, the large cap growth, IWF, and even the big caps and the XLK moving higher. That's the dynamic for now. Things will begin to sort out in the post-FOMC. You'll see the real reaction of the FOMC beginning tomorrow. things will begin to shuffle around. But the initial reaction should be sticking with AI, sticking with the big caps, and then they begin to soften as we anticipate Apple and Amazon. And I think that we have a disappointment in one of those. And after that, we're going to have to rotate somewhere else. If the dollar continues to go down, if bonds are not surging, then you got to do it in the market. And I think it's going to be back in dividend and value. I don't think it's going to be in the IWM. In any case, let's do commodities. Huge day for crude oil, energy, 5% in WTI, over 4% in Brent. Even the gasoline RBOB with gains of about 5%. Heating oil up by more than 4%. That comes at the expense of natural gas. Still waiting for that bullish momentum to show up. But so long as the flows in energy are chasing WTI, Brent, gasoline, and RBOB, they're abandoning natural gas for now. But we see pullbacks in softs, cocoa, cotton, OJ, coffee, lumber, sugar, all of them are down, be it modestly. But then we have the dollar sensitive, and we look at the yen, up 2%, dollar down 0.5 percentage point. I think without the yen, the dollar should have been positive today, based on the action by JP. So the yen is the wild card that is masking the action in the dollar, but it's giving a reaction, algorithmic reaction in commodities by moving energy higher and moving the dollar-sensitive metals higher. Huge rebounds in gold, silver, platinum, copper, even palladium is participating, up a little over 4.25%. You look at meats, lean hogs, the only one in the green. You look at grains, the gains are led by soybean oil and canola, so the oils are doing pretty good. Not so hot so for corn, though, down a little over 1.5%. Big casino options, what do we do here? The volume is beginning to come back as we get a rebound and trap some buyers here. It's amazing. Today, I was watching the chat for a little bit, and I have my biggest hardcore bears you've ever seen. And they're actually talking about buying the dip and talking positively about NVIDIA and the IWM going higher. Bad sign, okay? But anyhow, we look at the IV rank here. The volume moved higher and NVIDIA stays higher. AMD, of course, with the big move up and down, we see 1.5 million contracts. Tesla remain hot, but the rest are still in the low volume territory. Specifically Apple. I mean, we're talking about 500,000 contracts. Apple used to score 1 million, 2 million contracts a day. So the action is still light, and we still see inflows into puts. And this is why I say you got to be careful. It could be a trap. But the take here, folks, the IV rank matters. For all of you who say it doesn't matter, options don't matter, it does matter. When the IV rank gets to 100 in one direction, up or down, it means that the option's already tapped out. If you're buying the options in the same direction, you're just giving your money to the market maker. And in this case, yesterday, NVIDIA went to 100 in the IV rank. The put options were extremely expensive. If you bought them, the market maker thanks you very much. Now we get the IV rank down to the mid-80s. Tomorrow, I think we get it down to 80 or maybe the high 70s. Then we stall in NVIDIA and we begin to increase the IV rank again on the downside. So buckle up your seatbelts. The show is going to get really interesting. Anyhow, we move to the flows, bullish versus bearish flows on the buy side. On the buy side, buying calls, we got Amazon. By the way, it's a pump and dump. I'll show you in a minute. Microsoft, Meta, SMH, WDC, ASML. So a lot of bullishness in chips, but the absence from the bullishness in chips is Taiwan. So that's really interesting. The weakest link right now in chips is Taiwan. Because, by the way, Taiwan is not exempt from the rumor that we have exemptions. In any case, we see bullish activities for crude oil, so that's moving higher. You see AVGO, NVIDIA, so SMCI, Micron, so the action speaks for itself here. GLD going higher, so they were betting the right bets here since the beginning of the day. They bought the puts in the futures, they bought puts on the XME metals, GPN, Global Payments, Blackstone, TQs, so but not a lot of bearish activities today. In terms of buying the puts, we look at the sell side, bullish versus bearish. Bullish meaning closing the puts in INTC, Intel, CrowdStrike, Pinduoduo, Pinterest. So some of these names, I mean, USO comes with the territory of the rebound, but maybe Intel here getting close to more positive action as we close the puts. CrowdStrike, we're closing the puts, but there's no buying of calls, so we're not moving higher yet in CrowdStrike. On the bearish flows for the sell side, meaning selling the calls, TLT, baby. Are you noticing or not? So a lot of you, Maverick, you were wrong. You said this and that. And yields went down. You gotta get the reaction after the FOMC. And the fact that they're closing about $14 million of bullish bets on the TLT. What does that tell you? TLT coming down, yields coming back up. They're closing calls on BDO, Bitcoin, closing calls on Amazon. It ties in with what we just looked at as Amazon having bullish flows on the buy side. I'm going to show you in a minute. But they're closing calls on Apple, AMD, SMH, Taiwan. So Taiwan is the weakest link here in the chip components. Here's Amazon for you. Why did Amazon outperform the big caps today? Because we see the pump that we've seen before, I think last week, where somebody goes in and buys the 190 or the 200 calls on Amazon in huge quantities. These are sweep trades by an institutional buyer. And then what do? They paint the tape, the stock goes higher, 1 to 2%. They book the profits right away. They close all of these calls. In, out, hello, goodbye. And they walk out with hundreds of thousands, if not millions of dollars worth of profits. So the pop in Amazon, not sustainable. I think that we have the earnings report tomorrow, and the movement of the stock will depend on the report. Today's pop was based on the options market. Let's do some of the unusual activities. What do we have here? We got in the bullish side, ASML, exempt, unless we get a news that says the exemption is a Fugazi story. But if it's not, then ASML should benefit a little more and continue to advance higher. Somebody bought right off the gate. The 930 calls, expiration date September 20, spending about $3.5 million. They're already up about 15% in that trade, so not bad. And then we have bullish activities for Crude. Somebody bought the 88 calls, expiration date November 15th, spending a little over $500,000 on those. The trade is already up 20%. Again, it ties in with the bullishness that we've seen in crude today. And going all the way to November, it tells us that we're going to see higher oil prices for the reasons that we talked about vis-a-vis the Japanese yen and the dollar or the geopolitical risk. Here we have bullish calls on GLD. They bought the 230 calls, expiration date October 18th, spending about $2 million. GLD making new highs. The trade is already up about 25%. So they made the right call, and gold and oil will go higher together. Geopolitical risk, yen going higher, devaluation of the dollar, at least the shadow devaluation of the dollar. Then we have bullish calls for LAD, Lithium Motors. This is a really interesting one because the trade is already up big right now, but we think that we have more gains to come. They bought the 280 calls, expiration date August 16th, spending about $900,000. The trade is up already over 25%, and this chart is battered, bruised, but now it's coming back to life. There's probably some gamma squeeze, short squeeze going on based on upcoming news. I think that's what they're positioning themselves into. We've seen good news about the auto market. I know a lot of you are involved in the auto market. You got businesses like dealers and auctions and such. You've been telling me that, hey, the market is heating up again. It's heating up the same reason as the housing market is heating up, which is for the bad reasons. Folks are either losing their jobs or they see that maybe the market is peaking and they need to get rid of their inventory. And they increase the supply so the price goes down, good for inflation, but also good for the businesses involved in auto sales and auctions like Lithium Motors. And you saw Carvana also going higher after the bell. Then we look at the bearish activities, the XME. This is a big one. There's something going on here. Somebody bought the 54 puts for the expiration date of September 20th and December 20th, spending about $6 million on those. Now, it shows that the trade is up over 200%. I think this is just because the bid versus the ask widen up at the end of the day. But the trade is not up because the XME was up today. But why are they betting on the XME going down? The only reason I could think of is either a recession reason, so we see steel crashing, we see a lot of the XME components crashing, which by the way includes gold, so it doesn't make sense here, or the dollar is spiking higher. If that is the case, then yeah, the XME will go down, including gold. I don't see it though, and I'd rather be specific if you're going to short metals, not to include gold and silver, at least not right now. Then we got a bear put spread for PHM Pulte. Somebody bought the 128 puts and they sold the 120 puts. The expiration date August 30, spending about $400,000. What is a bet on? It's a bet on the data that we just got in the macro, with pending home sales going higher, supply going higher, prices going down. Not good for the home builders. Maybe they're betting on a rebound in yields as we see the real reaction to the FOMC tomorrow. If that is the case, then the home builders will soften and go down. Then we have another one here for Dell Technologies. Somebody bought the 115 puts for the expiration date August 16th, spending about $2 million. They're already up in the trade. It's really interesting that they're betting against Dell here. So maybe that's the weakest link in the AI mania, the hardware. I think Supermicro is coming out really soon, so that's going to have an impact on Dell. Anyhow, let's do some charts here, folks, and then wrap it up. We begin with SPY, the S&P 500. What do we see here on the hourly chart? If you can't beat it, you can cheat. Beat it meaning 547. Couldn't beat it once, twice, third time, fourth time, fifth time. Couldn't beat it. But you can cheat overnight. You can do the end of the month shenanigans as the managers, they got a rough July, but you got to score a bonus somehow. So they try to pump the market higher overnight. Mission accomplished, but right now we do have a bull flag pattern. We're not overbought in the RSI and the hourly. We have bullish momentum going on in the MACD, so we think that we could go higher tomorrow, at least initially, based on Meta and Nvidia and all of that. Maybe close the gap at around 553, maybe 555, but then if we get there, if we get to 555, I'm taking a short in the SPY. If we look at the daily chart, we're short of the 20 days moving average. That's observation number one, but we're closing a gap, so that's good that we're closing a gap. It could also open the opportunity for a pullback tomorrow after closing the gap. The other observation is you look at the MACD indicator, it is improving, at least it bottomed right now on exactly the zero line, which we usually see defense at showing up. If it fails though, such as before the 20 days moving average, failing to close above the 20 days moving average, and you see the MACD dipping into negative, not holding on to the zero line and turning positive, that'll be your indicator this is a bull trap and we have another leg down. The E-mini futures, what do we see here? We got a response to the 20 days moving average. We could not beat the top of the breakdown candle despite the big rebound today. Good news is we closed above the trend line, but again, you have a lot to do here to convince me that we're done with the correction, such as closing above the 20 days moving average. Now we'll look at the cash index, the SPX, this is the weekly chart. On the weekly, we're beginning to lose momentum in the MACD. We're holding on to the trend line. So any failure that you see in the daily charts, we're going to begin to get heavy on betting to the downside in the SPY and the S&P 500 for September and October. Because a failure in the daily, it means that the weekly chart will play the bearish momentum to completion. We're going to go down the zero line, ending the bullish wave that began in the fourth quarter last year on the weekly chart. That means at least we go down a tick below 5,000. So that's the juicy trade in the weekly chart. But you got to track the weakness in the daily chart first. The Q's hourly chart, what do we see here? Again, you can't beat resistance at about 466, 467. Well, you can cheat above it. And we did that today. Are we overbought in the RSI? No. Overbought in the MACD? No. Forming a bull flag pattern? Got it. With Meta and Nvidia going higher after the bell, I think that we see at least an attempt to closing the gap. Then we're going to stall and begin to reverse down. If we look at the daily chart, support from the 100 days moving average led by Nvidia. Got it. Did we close above the top of the breakdown candle? No. Did we close above the 50 days moving average? No. So there was no confirmation here that we're done with the correction. We need to see more confirmations. Otherwise, the assumption is whatever rebound this is, then down we go again. Let's look at the NASDAQ futures hourly chart. Yesterday, we got a break below the bearish line, 19,000. Today, we have a breakout above the bullish line, 19,390.5. My opinion, 2 cents. False breakouts on both sides will be back within the box, the consolidation range again. And the real breakout will be the first breakout below 19,000. We look at the NASDAQ futures on the daily chart perspective. We stopped in this rebound almost to the penny at 19,612.25, which is my resistance line, which by the way coincides with, if we plug in the 50 days moving average, yep, exactly the same. We could stop right here, folks. We need to see a closing, not just a pass above, but a closing above the 50 to say, okay, we got more juice to this rebound. Then we have to close above the top of the breakdown candle before we say, okay, we're now out of the woods. We're going to challenge the highs again. But I have a hunch here that it's not going to work out this way. That we're not through yet with the downside. But you need to see a closing above the 50 to confirm that, okay, at least in the short run, the downside risk is really, really limited. We look at the IWM. A breach above the Fibonacci retracement levels. I think we got them correctly. I don't think that we got them wrong. The top is not here yet. And what's really interesting is the momentum is slowing down in the IWM. Now, we have a lot of talk that the IWM should be benefiting from what the Fed says today, or said today, but it already did. It already priced everything good that the Fed said today. Now we have to look at other dynamics, such as the grass is greener in the big caps again, and the AI mania, such as what's going to happen with the Bank of Japan reducing the bond purchases. What happens if we have a rebound at the longer end of the yield curve? That we might trim some of these gains in the IWM. We got support at 218. That'll be the first support, and then we'll see what happens. And by the way, as I said in the stream today, you saw it tick by tick. The gains in the IWM come at the expense of the NASDAQ. The gains in the NASDAQ come at the expense of the IWM. That's the rotational nature of the market. So if we're talking about the big caps and the chips having more juice to squeeze to the upside, I think it comes at the expense of the IWM pulling back. Here's the Dixie, the dollar, rejection from the 20, and now showing us a bearish pattern. But you got to understand this. I don't think it's happening because the Fed cut rates all of a sudden. No, the Fed did not cut. I think the dollar should have been higher, but because of the action in the Japanese yen, we see the dollar under pressure. It doesn't matter because the end impact is the old man gold moving higher again. crossing above the important line, 2,431.78, solidifying that it was a pullback worthy of buying into, as we've been saying in this channel for a while. The SLV silver, we're closing the gap. I'm not a fan of silver as much as I'm a fan of gold, but to each his own. Some folks like silver. It's cheaper, it's higher beta. Got it. You can ride the ride in silver so long as the dollar goes down, so long as we're trading above the 100 days moving average in red. We lose the 100, you got to reconsider, and maybe gold will be a safer bet than the SLV. Let's do crude oil. Huge response today, erasing almost 3 downside candles in a row. So we have a bullish engulfing candle. The bad news is we failed to close above the Fibonacci retracement of 78.15. I think we get that tomorrow. If we do, then I think we continue in this breakout in oil for the reasons we just talked about. Now, what happens with oil stocks? Because the XLE went down. In this period right now, at least in the next few days, if you're going to bet bullish in oil, I'd rather be in the USO. As I'm showing you right now, USO, we pointed out the oversold conditions got a big pop today. If you traded the options on it, the daily options, you scored over 1,000% worth of gains today. But the reason why I say right now, the immediate short run, USO over the equities, because we have earnings coming out for these equities, Exxon and the likes, but also we have a weakening of the rotation today. You saw in the heat map names like J&J, AbbVie, Bristol-Myers, the dividend-paying names, the value names, went down as the action floats back into the IWM, not the RWM, but the chips and the big cap mania. I think that dynamic, if it continues into tomorrow, it harms the XLE, but we might see the commodity continuing to go higher. So USO right now over the XLE, but that dynamic might change as soon as we see a stall and a pullback in the rotation back to the AI mania and the big caps. That could be because of Apple, because of Amazon, because it just gets overbought in the short run. All of these are valid reasons. We'll look at the 2-year yield. We don't have a falling wedge. We actually shit the bed here in the 2-year yield. My 2 cents though, we're going to see a rebound beginning tomorrow, but it's going to be the 10 outperforming the 2. And that's going to be a bad leading indicator that we're getting close to the end of the rebound of the NASDAQ and the SPY. If yields go higher, of course, the rotation is not going to be pretty good. XHB right now, still safe above 117.17. We talked about the supply problem. We talked about the bearish trade in Pulte. We talked about the possibility by tomorrow that we see yields coming back up. If they cause the chart to lose 117.17, yes, you want to enter short trades in the XHB with the aim of, let's say, 112.5, and then we'll see what happens. The IYR was negative today. It couldn't pass 94.88, the previous high. And again, any rebound in the 30 tomorrow, I think we're going to do it. You're going to see the IYR going down. The KRE already weak, so it did not benefit from the Fed. What does that tell you? Even if we got any good news that folks are anticipating, it was already priced in, so we have sell the news. I think we see that the rotation weakens into tomorrow because yields go higher and the grass is greener in the big caps and in chips right now. Look at the VIX. They don't really flush down. I mean, the NASDAQ was up, 2% plus, 3%. The SPY was up big, but the VIX didn't register a big drop here at all. It's still holding the support line. I think the VIX is not done. It might dip down a little more tomorrow, but so long as we keep the lows of the breakout candle, as I'm pointing out in the video right now, I think the VIX is heading higher. Evident by the weekly chart in the VIX above the 20, forming a bull flag, not done in the momentum in the RSI and the MACD, so I think the VIX is still going higher, which means that the rebound right now is trappy and not proven yet. We look at Apple. Yesterday we closed the Apple puts at about 40 to 50% gains in options tracker if you're following. I think I made the right decision because we stalled in Apple at the 220 line. We have a report coming out tomorrow. If you're sitting on profits in the puts, the right decision was to close, and we did that. Now we see a move higher, a cheat above 220 because we couldn't do it organically. So we got a cheat in the pre-market session. Now forming a bull flag pattern, I would not be surprised to see a move above 223.25 tomorrow. But boy, if it reverses down, closes below 220, I think it's because the report, somebody looking at the report anticipating that it's going to be bad. You look at the daily chart. If we stall here and move down, could be forming a topping head and shoulder pattern in the big kahuna. Looking at the souffle Tesla, what do we see here? They're still trying to move it higher at the 234, 235 level, but they're having a hard time. And I'm going to stick with the outlook that we're probably going to see more downside than going up to closing the gap. And that's the possibility of an inverse ABC as we've been talking about, or a bear flag pattern that's just consolidating right now. We're going to face a failure and then head down. You got to see it closing above 235 in Tesla for the risk to become at least a visit to the 20 days moving average, if not closing the gap. But you got to get 235. Right now, the folks who are betting on call options, that's what really moves the stock. They were aiming for 232.5. So once we got there, we stopped and went down. If they up the bets to the 235 or 240, then they might be successful in moving the tape higher. But again, looking at all of the factors, folks, I think the risk is more predominantly the downside than the upside. Here's NVIDIA for your daily chart. Rebound of the 100. Big pop today, worth 10%, 11%, but it doesn't show in the chart. It shows us, just a regular rebound. The stock lost over $1 trillion on the way down, gained 300 billion plus in single day. It's amazing how we're looking at these billions and trillions as if we're playing a video game. In any case, confirmation that we're out of the woods in the daily chart, closing above the 20 days moving average. Otherwise, the rebound is still a dead cat bounce for now. When we look at the hourly chart, we have one accomplishment here by NVIDIA, which is closing a tick above 117 in a bull flag pattern. I think we continue in that momentum, but we try to close the gap at around 122. At that point, the RSI becomes really overbought in the hourly, and we begin to see a pullback in Meta. It could come by the Meta, in NVIDIA, maybe a slip that Meta will go down to. And it could be, by the way, a big gap up in the morning, and then we faded right away. And then we got tulips. Bitcoin, what do we see here? Breaching the 20 days moving average, clear rejection of 67,000. No confirmation though, because we're still above 63,000. So right now, you look at the MACD, confirmation of bearish momentum. So you can begin to bet against Bitcoin, but you got to be light because we don't have a solid confirmation yet. Maybe, for example, if you look at Coinbase, you can take a shot on it tomorrow if we see Bitcoin down. You can take a shot that Coinbase will go down all the way to the lower Bollinger Bands, closer to that number, and then close the trade before earnings because you don't know what that fundamental catalyst is going to show. The same, by the way, in MicroStrategy, which is reporting really soon. Let's move on to the conclusion of this video. What do we have in the economic calendar tomorrow? We're going to do a brief tomorrow because we're going to talk about the stuff that we got today. And tomorrow we got important macro indicators from initial jobless claims to productivity to the manufacturing PMI and ISM. On top of that, we have construction spending, all important for the economy. On the earnings calendar, it couldn't get any important than this. Two major names, the collective value of about $5.5 trillion at stake. We're talking about Apple and Amazon. Then we have Intel. Hard to read Intel because on one hand, you have the trade in the options market of closing the puts, suggests that Intel might go higher. But then on the other hand, they announced the massive layoffs ahead of time. As if they're saying, folks, our earnings will be absolutely horrific. So we're letting you know right off the gate that it's going to be bad, but we're fixing it because we're laying off over 10,000 employees. Priced in, the market is not going to be upset because of the layoffs. Fixing it, we'll see. Then we got ConocoPhillips, Booking.com, Eaton, Regeneron, Cigna, all important names. Another interesting day coming out tomorrow. And the real reaction for the post-FOMC. Buckle up, ladies and gentlemen, but this is all I got for you for now. Hope you found the video informative, and if you liked it, well, you're already a member, so you're doing your job. Thank you so much. Appreciate you joining us here. Thank you for listening. Thank you for watching. Now we'll talk to you again tomorrow. Good night.
You say you have, you're a slut. It's a trap.